All right, today we are diving deep into one of the most powerful signals you can find in price action trading. Seriously, it's a pattern that basically shows you a real-time fight between buyers and sellers, and it tells you who's about to win. Yep, we're talking about the rejection candle. If you stick with me, you're going to learn exactly how to see it, how to build a whole trading plan around it, and, this is the important part, how to manage your risk. Let's get into it. You know the feeling, right? We have all been there. You see the price just screaming towards a huge level, a major support or resistance zone. Your heart starts pounding a little faster. Is this it? Is this the breakout we've been waiting for? Or is it a trap, a classic fake out just waiting to suck you in right before the whole thing reverses? That moment, that split second of uncertainty is what makes or breaks a trader. So how do we cut through that noise? Well, that's what we're here to figure out. First, we'll look at the actual battlefield, those key levels. Then we'll define exactly what a rejection candle is and what story it's telling us. After that, we'll get tactical with a 4-step trading plan. Of course, we have to talk about risk and mindset, the guardrails that keep you in the game. And finally, we'll wrap it up by looking at some real-world examples to see how this all works in practice. Look, you have to think of every chart as a battlefield. And the fiercest fighting, it always happens at these key levels. We're talking about those support and resistance lines or those big trend lines that everybody has their eyes on. This is where buyers and sellers literally draw a line in the sand, and whoever wins that fight is going to decide where the market goes next. Every single candlestick leaves behind clues, but the wick? Oh, the wick tells a whole story. Think of a really long wick, like this one, as the footprint of a failed attack. It shows you the exact spot where one side, either the buyers or the sellers, made a huge push, only to get completely slammed back by the other side. That wick is the story of rejection, and it's written right there on your chart for you to read. And that brings us to the star of the show, the rejection candle itself. This pattern is the ultimate clue. It's what helps us figure out who won that fight at the key level, giving us a pretty high probability guess as to where the price is likely headed. So let's get specific. What exactly are we looking for? A rejection candle really has two main features: a long wick, sometimes called a shadow, and a pretty small body. That long wick is everything. As a rule of thumb, you want it to be at least 2 or 3 times bigger than the body. Why? Because that structure is a massive visual clue that one side tried to take control, but the other side just completely rejected that move, and they did it with force. The longer that wick, the more violent the rejection. And they come in 2 main flavors. Over on the left, you've got the bullish rejection, which you've probably heard called a hammer. It's got that long lower wick, right? This happens at a support level, and it shows us that sellers tried their best to push the price down, but buyers came storming back in and drove the price all the way back up. It's a sign of seller exhaustion and a huge surge in buyer confidence. Then on the right, you've got the exact opposite, the bearish rejection or shooting star. Here you see a long upper wick at a resistance level. This tells us buyers tried to push things higher, but they just got crushed by sellers. It's like buyer excitement hitting a total brick wall. Okay, so knowing what a rejection candle is, that's one thing. But knowing how to actually trade it, that's the real key. So let's get into the tactical playbook. This is where we turn all this theory into real, actionable steps. So our plan has 4 simple steps. Step 1, find the level. This is huge. You can't just find these candles anywhere. They have to be at a significant pre-existing level the market cares about. A support zone, a resistance line, a major trend line. A rejection candle in the middle of nowhere means almost nothing. Step 2, wait for the signal. This is all about patience. You have to wait for a clean rejection candle to form and close right at your level. Don't you dare jump the gun. Step 3, get confirmation. Now, a rejection candle is strong, but it's even stronger if you have other clues backing it up. Is the overall trend on your side? Did volume spike when the rejection happened? These things add conviction. And finally, step 4, plan your trade. This is where you map out your exact entry, your non-negotiable stop loss, and a realistic target before you ever put any money on the line. Now, a killer strategy is totally worthless if you don't have guardrails to protect yourself. I'm gonna say it right now. This next part on risk and mindset is easily the most important part of this whole explainer. If you get this right, you have a real sustainable edge. And this quote just says it all, doesn't it? Your number one job as a trader is not to make a profit. It's to be a professional risk manager. Profit is just the happy side effect of managing risk really, really well. Before you even think about how much you could win, you have to decide and accept how much you're willing to lose if you're wrong. Okay, so let's make it real. For your entry, a solid approach is to get in near the close of that rejection candle, or maybe wait for the next candle to confirm that momentum is going your way. Now, your stop loss. This is everything. You place it just on the other side of the very tip of that long wick. That is your line in the sand. If the price goes past that point, your entire reason for being in the trade is gone, and you get out, period. And finally, position size. This isn't a guess. You calculate it. Based on the distance from your entry to your stop, you figure out exactly how much to trade, so you're only risking a tiny preset amount of your account, like 1%, on this one idea. And locked in with that mechanical risk is your mindset. Trading this pattern demands so much patience. You can't just make a setup appear. You have to wait for the market to hand it to you. And when it does, you have to trust the story the wicks are telling you. Oh, and if you miss a perfect one, let it go. Chasing a trade after it's already left the station is one of the quickest ways to burn through your account. And remember, even a failed signal tells you something important. It might be saying the underlying trend is way stronger than you thought. All right, theory's great, but let's see what this actually looks like on some real charts. We're going to check out one that worked perfectly and one that was a total fake out, just so we get the full picture. Okay, check this out. This is a beautiful example on the daily chart for gold. You can see this super clear resistance level right at that big psychological number, $2,000. Price comes rallying hard into it. Buyers are feeling great. It even pokes its head above it for a little while, but then, bam, the sellers step in and just hammer it all the way back down, forcing it to close way below resistance and leaving that monster of an upper wick. That is a textbook shooting star. If you entered near the close of that candle with your stop just above that high, you would have been perfectly set up for the huge drop that came next. This is the pattern playing out exactly like it's supposed to. And now, for a little reality check, because not every signal is a winner. Here on a Bitcoin chart, we see the price dropping down to a pretty clear support level, and it forms what looks like a great bullish rejection candle, a hammer with a nice long lower wick. Looks like buyers are stepping in, right? But the next candle just has zero follow-through. The bigger picture, the overall market momentum, was just strongly bearish, and that context was everything. Instead of bouncing higher, sellers just took control again and smashed the price right through that support. Anyone trading this without a stop loss, they would have been in a world of hurt. And that is exactly why our stop loss is non-negotiable. It saves our skin when the signal fails. So what's the big takeaway from these two examples? It's that the rejection candle isn't some magic crystal ball. It's a tool that helps us spot moments of high probability. And the key things that separate a professional setup from just random market noise are these three things. Patience, to wait for the perfect signal at a key level. Confirmation from the bigger trend, and an unshakable discipline to honor your stop loss every single time, no matter what. The rejection candle is such an incredible tool because it's like getting a peek behind the curtain at that battle between buyers and sellers. But now I want to hear what you think. How often do you use rejection candles in your trading? Do you have a favorite confirmation tool you like to pair with them? Maybe a certain moving average or a volume indicator? Drop your most trusted setup down in the comments. Let's keep the conversation going. Thanks for watching, and as always, trade safe.